All right, guys, time now for round 3. Let me just take a look at the board right now, since we are open and we've been everywhere this morning, you name it. We're down 116 points right now. Now, at one point earlier this morning, if you looked at the S&P, the Dow, and NASDAQ, we were down about 3% or north of that on the heels of what happened to Asia and Europe. We then rallied back. We were down only 22 points, for example, on the Dow. And as you can see right now, we're down 134. So we've gone back into that negative territory. But one of the big conversations that's going on right now is, what will this new commercial paper funding facility mean for corporations who need to get access to liquidity? Many people suggest that that could bring good news to the markets, although what has happened overseas is clearly having a ripple effect on what's happening here in the United States. All right, guys, let's quickly open it up for a round here. I guess, are we at round 3 or round 4? I'm losing track. We're at 3.
The market's winning.
Thank God they're talking to me in my ear. All right, guys, you know, when you look at where we are and the turbulence that we've experienced thus far, do we need to just fasten seatbelts and know that between now and year end, get used to it? It is not going to calm down. This is the world we live in.
Well, if you look at the VIX, that has been thrown around so much, and I wish someone who threw it around would look at some history. It only goes back to 1991. Prior to that, it was the VXO, which is the S&P 100, and then after the crash of '87, it went from 60. Before the crash, it was at 60. It went to 150 and hung there for 2 weeks. That can happen again. So when we see levels of 70, 80, 90, it doesn't mean it's the end.
We saw 90 on Friday, and everybody said, all right, well, we are now at the optimum fear level, therefore the market should be leveling off. They've been telling me that when it hit 40 and 50 and 60 and 70, and I'm saying it hit 150 and hung there for 2 weeks after the crash of '87. And in the crash of '87, you had a rebound, you hung there for a few weeks, and then by December 4th or 5th, you came back and retested that low level almost to the number. It was within a small percentage difference. So. All right. One of the things we said we talk about at the very beginning, Connell, is we said we talk about the catalyst for the market. I mentioned commercial paper. I mentioned the interest rate thing, but also it is year end for mutual funds on Friday. How important is that because of the selling of due to redemption?
Right. Not only mutual funds, but we're coming up on dates where people have to get their hedge fund redemptions in as well by the end of the year. So both of those things could play a factor. Listen, I think you know, on a more macro level, it really comes down to how you view the economy, and I'm talking about the world economy and how negative your view is. Because I'm talking to a lot of people who have a very, very negative view, and they make the case that all these people, and I think somebody mentioned this earlier, that want to come in and buy on quote-unquote weakness, people who have a very negative view of the economy say, why? Why are you doing that when, you know, we think that we need to get all these sellers to get out of here, let things flush itself to a level that we haven't seen yet and break through these lows, get it all done and over with, and then maybe we can start to build something. But there are people, and I can see their argument, that want to buy on weakness because they say, well, why should I be selling here and going into treasuries where I can get no yield and the rest of it? So it's a very difficult situation.
Okay, Robert Gray, a couple of quick points. Number one, normally the markets recover 6 months before the economy starts to recover. If we started to see a recovery in November, that would suggest a recovery perhaps in April or May. And a lot of people are saying, yes, the first 2 quarters of the year could still be ugly with negative GDP, but we might start to see some of the signs of the economy getting back on level playing field. If that were in fact the case, are we at real, pure, discounted valuations where you have to start to get in there and start nibbling?
Well, certainly Warren Buffett and a few others have been very vocal about it. I mean, you look at historical measurements, maybe price to earnings not the best right now because the earnings component is highly in question, but price to book value, you know, how is it worth compared to, you know, the value of the company, its businesses, and what it could liquidate at. And people are saying that's historically at a good value. The problem is we don't know, you know, how the shape of that business is going to hold up right now, and there's so many uncertainties. We're not trading on fundamentals by all accounts that I've been speaking to, and what Keenan's been saying as well today. And you've got, you know, this deleveraging is continuing. You've got the end of the mutual funds. You've got the end of the hedge funds. We have a presidential election coming up next week at Congress as well. There's just a lot of balls in the air right now, and I think most people that I'm talking to are sort of going to wait and let the dust settle over the next couple of weeks, which leaves fewer buyers in the market, Alexis, right now, who would be natural buyers, especially when you hear about a CalPERS out there who's had to sell stock to raise money because of bad investments elsewhere. So when you have all of these things combining right now, you've got, you know, far more sellers than buyers, and particularly when you look at the mutual fund redemption. Americans have been selling out of their mutual funds, and the allocation into stocks by some measurements is at the lowest we've seen in years right now.
Yeah. No, it's interesting, Ashley, because as Keenan rightly pointed out, though, you could see a snapback rally over a course of a couple of days that could be tremendous. I would imagine right now that cash is king.
Oh, absolutely, and there's lots of it on the sideline. I mean, if you're looking to buy a stock today, there's a pretty good chance it's going to be worth less tomorrow. No guarantees, but I think that's true. But if you're in for the moderate and long term, there's no problem in jumping in right now. Of course, you want to maximize your profit, so you may wait because you think it's going to go down lower. But if you think moderate and long term, you're going to make money and you're going to do okay. But I don't think anyone can predict exactly where the markets are going right now. Until we see all of these moves being made by the central banks and governments and actually see the liquidity. I mean, I'd like to see the banks actually start, getting going here, lending to each other, and we actually see the results of that. That's when we can start looking at the economy turning around. But until we see that, it's still going to be very volatile.
All right, guys, let's leave it there. Thank you guys so much. Great.
First and foremost,